on vacation, though I haven't been. Working with you guys is no vacation. I just want you to know that. Well, again, good morning. Here with me today is Dr. Fred Gertz. Dr. Fred, good to see you.
Yeah, good to be here.
Certified financial planners Ryan Repko and David Ruedi.
Good morning. Good morning.
I know I'm supposed to say certified financial planner professionals,
which is so awkward.
I know it is. It comes out hard. You can call in with your questions to 356-9397 or text us on the Castle Heating and Cooling text line at 351-5357. You can also email your questions to talk@WDWS. We also want to welcome those tuning in on Facebook Live. And we just heard Facebook Live. Maybe we'll get some money, right? Of course, you probably have to have an account that says. It's important to recognize that past performance is not an indication of future results. You should not make any investment decisions without first consulting your own financial advisor and conducting your own research and due diligence. I'm going to start out, Ryan, you're our compliance officer, so earmuffs. I just want to thank everybody. We're not making a big deal or writing commercials about it, but I do want to take a moment to thank people for voting us the #1. And I'm going to have a caveat, Ryan. So voting us the #1 investment firm in the Central Illinois People's Choice Awards. But then I have to go on and say you really shouldn't pick an advisor based on something like that. So I know that sounds strange that I would say that, but I want to acknowledge the fact that people went out of their way to vote us as #1. And in all fairness, that doesn't mean that we're necessarily the best returns or the best for people's clients. It's kind of a popularity contest. So let's call it for what it is. It's not a basis to choose a financial advisor. But again, just to acknowledge that being chosen #1, it makes me feel good. Maybe it's because I'm going to be 60 in November and finally something good's happened to me.
Wow, I can't believe you're admitting that on the air.
So are you happy the way I disclosed that and said, don't pick people because they're just ranked #1? Now, I think in some fields, there's probably appropriate, the roofers and things like that are #1. Maybe that does mean that those are the ones you should choose. So sorry about that. Probably clumsy for you guys to hear me trundle through that. I think it's nice to acknowledge that. Thank people for voting us that way. Well, guys, Fred, we won't go into this yet. It seems like up until this morning at about 6 o'clock in the morning, everybody's biggest fears we got a recession starting tomorrow. It's amazing how psychology changes on a dime, and here we were yesterday, maybe 4% from all-time highs, and once again, it's existential terror announced. And I don't know how investors it makes me realize why human nature makes it so tough to be a successful investor when you're bombarded by basically schizophrenic financial media.
Right. And it's also a more volatile situation the last month or two compared to the past. But again, that kind of volatility is something you have to expect. But again, it's a kind of difficult situation now. Everyone talks about uncertainty being a problem for investments, and not the kind of investors we're talking about, but building a new factory or something of that sort. But that's certainly the case now. If you're an American manufacturer and you said, should I build a factory because business in China is going to come here? Right. It might be that way today. It might not be tomorrow. So it's very difficult to make any kind of long-term plans in that kind of environment.
And all stock market investors are trying to do is decide what the future is worth today, future earnings, et cetera.
Right.
And then just on a dime, we get a tweet, probably was a tweet, I don't know, that now maybe these tariffs that were supposed to start, I think towards the beginning of September, have been delayed till December, and maybe there's some relief for Apple. And, as if it really has anything to do with anything. And
another example is the 0.25% change in the interest rate from the Fed. I mean, that's so minute that it can't have any real impact, but it was kind of a signal for people. So things are driven by changes that are probably insignificant and intrinsically insignificant.
It's just amazing how quickly it turns on a dime. But, I try to remind people and investors that are going to own the great companies of America and the world, look, fluctuation, volatility is your friend. It fluctuates around a permanent rising uptrend. And if it didn't fluctuate, if it didn't crash every now and then, if stock returns were guaranteed, they'd be so overpriced. And part of what keeps things from getting, and probably creates bubbles, but in some way there's this limits to within reason, because there is that risk that I may suffer a sudden 20 or 30 or 40% temporary decline. I won't call it a loss, but the financial media would call it a loss. I'd call it a temporary decline along the permanent uptrend. It's a necessary ingredient for if you're reaching for higher expected returns for stocks. Interest rates have now, it wasn't 6 months ago that interest rates were going to be out of runaway train on the upside. And suddenly we're back to a 1.7% 10-year treasury. And the yield on the Standard & Poor's 500, the dividend yield's probably closer to 2%. So you can actually earn more. It's not a suggestion to go out and buy as an alternative to treasuries, but
a new situation. We had negative interest rates and short-term rates in some foreign countries, but now they're actually long-term negative interest rates. So people are investing money for 10 years with basically zero return. So it's a different kind of world.
And much of the world is even lower or even has negative interest rates. There was a bank in Denmark that's now making negative interest rate mortgages. Right. In other words, I guess that means they're assuming they'll rather take a small loss than maybe expose themselves to bigger losses by locking in, actually pay you to take a loan. It's really, that's a
if they can borrow money for even a lower negative rate, they're all right.
So in the backdrop of that, our a 10-year treasury at 1.7 or whatever at near historical lows, it seems like there would be a lot of gravity against rising interest rates in a world that is basically much lower or even negative interest rates around the globe. I don't want to overplay that. It's not everybody, but there's certainly a good number of countries that have negative interest rates.
Well, it'll be interesting to see whether the banks come down with CD rates, because they've been creeping up a little bit, and now they'll probably go back to where they were, which is probably close to zero.
Right. And so for people that might have locked in a 2 or 3 or 4 year rate a month ago or 2 months ago, speaking which, mortgage rates are almost as low as I've ever seen them. Not quite at historical lows, but at least last week they were around 3.5%, roughly. And you start thinking about that, that's kicking off a refinance boom. I also read something that it's much quicker now to get them, and I think I have it or had it somewhere. Let's see. I think no, that's different. I saw a chart that showed instead of like 55 days, I may be wrong here, but it's not by much. 4, 5, 6 years ago, it might have taken 55, 60 days. Now it's taking somewhere around 40 days. So it's becoming easier. So I think people have to think about their debt as an asset too, or in the same terms kind of as an asset, something to be managed. And if you're sitting in a 4% or a 4.25% or 4.5% mortgage, they were 4.5% not that long ago, guys. And suddenly you can go to a 3.5%-ish 30-year mortgage, something people ought to look at, take advantage of. I know I called your brother, David, or I text Paul and said, hey, I think you're at 4.25% or 4.5%. Go in and refinance. And hopefully he was smart enough to do that. I bet he is. He's pretty frugal.
I'm sure he's listening, wondering.
So it's just interesting, Fred. I don't really how investors, they should just ignore most of what's going on. It seems like from the pundits on the CNBC world and things like that, it would seem to me.
I had occasion this last week to talk to people I usually don't see, and it's strange how, or surprising to me how all the misinformation around still exists. People were talking about, I like to invest in my own stock, not buy mutual funds, because I like to choose the, and other people say, well, I like to invest in an actively managed fund because they have really smart managers who are doing things. And some people were saying, well, I have a friend who earned doubled his money in 2 years. And so even though we talk about the kind of the mainstream core investing kind of idea, there's still a lot of weird ideas around.
Well, I think in fact it's still, if you look at active management, which to me is kind of weird, that's kind of an exaggeration, but not really. But there's so much data that shows, trying to pick managers that are going to outperform is such a loser's game but yet the majority of people still play that game.
Yeah, and everyone I talked to did really well.
Exactly.
They don't calculate their return in a very precise way, but they always we're extremely good investors.
And one of the things, go ahead, Dave.
I was going to say, Daniel and I always joke about that because, sometimes when we're talking to people, if they're, the type of people who invest their own money, maybe they're picking stocks or whatever, and they hear you're a financial advisor, a lot of times they'll start talking to you about it. And almost always the wording is, I do pretty well for myself. It's like super vague. You can tell, like you said, they never actually track their like compound return over time. And it's always like, well, compared to what? Have you actually compared it to what you could just do with a low cost index fund?
Yeah, it's kind of like at what cost, where's the evidence, and compared to what? You know, they always leave those out. And it really sounds like what people that walking in the casino say, oh, I generally do pretty well in the casino.
Right.
And some things just hard, some things are just counterintuitive. The idea that I can go out and buy an index fund that isn't even managed by a person, it's managed by a computer, that all it does is simply track an index, is counterintuitive in a world where we're taught the harder you work, the smarter you work, the better your results in the aggregate. And this is one area where it just doesn't seem to work out. Well, we're also starting to hear, guys, I wonder what your take on it, if you're hearing it like I am, or maybe you're hearing it too, Fred, is, well, why not just buy the S&P 500? And when I say the S&P 500, I'm talking about the Standard & Poor's 500 index, which there are mutual funds that, because you can't buy the index itself, but there are mutual funds that basically mimic that index for next to nothing in cost. And all I can say is the last time I was getting questions like that, almost as if, well, why would anybody hire a financial advisor? Why wouldn't I just buy the Standard & Poor's 500 index fund? And it just reminds me, Fred, back in the 90s, in the mid to late 90s, that's exactly what it morphed into, why shouldn't I buy the NASDAQ 100 index? But it was basically the S&P 500. And it's because over the last 10 years, it's been the dominant asset class compared to almost anything else, and that happens in there, and that's not unusual at all. But these things tend to cycle, and it really implies that, well, why not just buy the largest companies in the U.S. and forget everything else around the globe, the other 12 or 13 or 14,000 companies, the different themes, the small companies, the large companies, value, growth, emerging market, all around the globe. And but that's starting to creep into conversations.
Yeah, it's the warning you always give that past returns don't predict the future. So again, if you had to go back 5 or 10 years, that would be a good strategy, but you didn't know that 5 or 10 years ago.
Right. And in my research, going back, looking at about the last 12 decades, 8 out of 12 decades, an equal weighted world global portfolio would have done better than the Standard & Poor's 500 index. But think about the last time people were saying that. It was late 90s. It was before 10 years of the lost decade, where the Standard & Poor's 500 index total return was down 10%. So if you had $100,000, you ended up the 10-year period roughly with $90,000. That on the front end of retirement can be ruinous almost. But yet during that same decade, emerging markets, international stocks were up somewhere 60, 70, 80%. These things cycle like that. And then you also said that just before one of the worst 20-year periods. So now if you don't just take the lost decade, you go the last 20 years as of today, the return on the Standard & Poor's 500 index has been below 6% per year. Now, to give that some backdrop and perspective, the average historical compounded annual rate of return has been 10%, approximately 10%, really close to 10%, a little bit over it. That's extraordinary, and we're going to get into that a little bit today. Does that mean anything? I wrote a blog about it called Something Extremely Rare Just Happened. You can see it on ruediwealth.com. I draw my own conclusions, and I'm going to add something to that blog, but people are starting to get a little squirrely in that regard. Do you guys catch any of that?
I would say definitely. And I think people need to remember too that the S&P 500 is really only one asset class. I think you hear 500 companies and you think, oh, I own a diversified investment, but they're all large US companies. And there have been times where, like in, the late 90s, early 2000s, where there was a big decline in the S&P 500, but the other asset classes didn't decline nearly as much.
Right.
So anytime you concentrate your portfolio in one asset class, your worst case scenarios are going to be a lot worse than if you were diversified across a bunch of different asset classes.
Right. Diversification is your friend, but sometimes diversification works when you wish it wouldn't. And look, I've noticed all the major guys on the radio, the Rick Edelmans of the world that's on and nationally syndicated, a lot of the others that have pretty significant followings. And maybe sometimes it's just a blog post. They're all sort of saying, hey, our performance is not as good as the Standard & Poor's 500 over the last block of time. But this isn't unusual, and it certainly doesn't make a case for lack of diversification. Now, within that Standard & Poor's 500 index fund, you're certainly well diversified in as far as the asset class itself, but you're avoiding the potential diversification benefits of adding other asset classes. So,
and also, again, it doesn't predict the future. The same idea, people are saying that pension funds could have done better the last 10 years by just buying the S&P 500 and
a bond fund,
and do better than all the esoteric and costly maneuvers. And it's true, but no one knows whether it's true for the next 10 years or not.
Most pension funds, if they were globally diversified, let's just say they give them the benefit of the doubt and they weren't even in all these alternative investments, which they are, but assuming that, they would be underperforming a standard 60-40 portfolio using this Standard & Poor's 500 index as the stock portion of the asset class. It doesn't mean anything. It just means they're more diversified, and that's just the deal. Some people can't deal with the deal, and they're always chasing their tail. What they're really chasing is they're letting the recency bias of what's happened in the last 3 or 4 or 5 years drive their portfolios over the next 10 or 20 years. And it's a classic mistake. I see it for 35 years. I've seen it over and over again. Even though there's more information at hand, all the information you ever want to know about investing is at hand. It hasn't changed one bit in 35 years as far as people still making that classic mistake of chasing recent performance of the hot asset class.
Well, and I think 10 years feels like such a long time to people. In human terms, it is a long time. It's, an 8th or 9th of your life for most people. It just seems like that should be meaningful, I guess. When you look at 10 years, it's like, oh, you would think you'd be able to draw conclusions from 10 years, a decade of performance. But it really is completely meaningless and tells you nothing about the future in investment terms. It's just not helpful.
In fact, it's almost a perverse indicator, though not perfect. It's not really usable, but it's almost a cruel trick it plays on investors, knowing that investors will look at a 5 or a 10-year period and draw those conclusions and then map their path of the future based on the past 3 or 4 or 5, 10 years.
On the other hand, though, it's actually sort of good that you didn't need that buffer. So again, you're taking a little bit lower return by being widely diversified in most cases, but you're obviously getting a lot of stability. So it's like buying insurance, and you're not unhappy when your house doesn't burn down. You're happy that it's still there, even though you paid the insurance,
right?
Because you don't want things to happen, bad things to happen, just because you're protecting yourself against the bad things.
You're just trying to reduce what they're called fat tail events, the big events that have a disproportionate impact on your life, and putting your money in one asset class just exposes you to more of that risk. But investors, being human, of course, draw conclusions after a 5 or a 10-year period that frankly are quite harmful to their health.
I think one thing that goes against diversification is you can rarely go to your friend's house and go to the barbecue and talk about how well my diversification strategies work. And I shot the lights out with diversification this year. And that's never going to be the case. It's not designed to do so. It's designed to essentially smooth out the highs and the lows so that you're never overbalanced in one particular sector. And that there goes the social psychology side of investing, is you don't get to brag so much as the guy who overweights and puts all the eggs in one basket and possibly shoots the lights out, or in most cases probably is going to have an underperforming portfolio relative to one that's diversified.
Yeah. And the same idea, people who have rebalanced the last 5 or 10 years with the stock market being really strong actually are worse off because they bought bonds instead of stocks, but they got that security. In the meantime, they still have that security they wouldn't have.
Yeah, as long as the central limit theorem works and Jensen's equality, is still kind of a law. It makes sense to be as diversified as you can within reason. And then there's no real right answer there, guys. Right? I mean, some people are into commodities and think that should be part of it. We don't. But those are kind of at the sideline issues. But I'd prefer to take a global approach as opposed to just one asset class. And of course, we don't have to look back. If you were a Japanese investor in the late 80s, the conclusions you would have drawn would have been, why would you invest anywhere but Japanese stocks compared to U.S. stocks? It was not even close. It was a slaughter. The performance of the Japanese stock market was multiples of the total return of the U.S. U.S. market. And last I looked, it's still lower than it was in 1989. That is the Nikkei average. So it was a complete disaster for Japanese investor to invest all of their money in there. And that Japan was no slouch. It was not a banana republic. It was a major economy, and it was a disaster for investors that were the Japanese investors that put all their money in the Japanese stock market, as opposed to taking a globally diversified. It's happened historically, Fred, over and over again.
And you have to be careful about diversity. Diversity is a complicated thing. Just having a bunch of different mutual funds doesn't make you diverse necessarily. You have to have ones that are not correlated with each other. So,
all right, we're going to go. I'm rusty. I'm going to go to John on one. John, are you there?
Yes, I am.
Yes, sir. How can we help you today?
I've got two questions.
Yes, sir.
One is talking about diversification. What do I consider my REIT fund? Is that a stock? Certainly not a bond. How do I, in the world of my asset
where does it fit
where
in?
Does that fall? Yeah.
I always count it towards the stock allocation. If you just look at the expected return and the level of risk or volatility, it's very similar to stocks, but it's not perfectly correlated to like publicly traded companies. It is real estate underlying that fund. So it can be a good diversifier for a portfolio, but from a big picture, stocks versus bonds, risk kind of return standpoint, I count it as part of the stock allocation.
And I like to think of it as more in line with small value stocks too. Yep. I think so. I would definitely, even though they tend to have a pretty high income component of the total return, it's tempting for some people to think, well, maybe that's bond-like characteristic, so maybe it's a hybrid, and it's really not. It tends to be. I would factor it in as just another asset class of stocks. And as an aside, of our U.S. Portion, it's 10% of our U.S. portion, just to show you that we respect that asset class and we do consider that a diversifier.
All right. One more question if there's time.
Sure, plenty of time.
All right. I spent my working life accumulating traditional 401k, not Roth, converted it to an IRA.
Okay.
Now I'm almost exclusively in a traditional IRA. What are the advantages? I mean, I understand I would pay the taxes now. It would grow tax-free, but why do I want to pay all those taxes now and do a conversion?
You probably don't. So yeah, that's the answer. Is
for most people, you'd say, David, probably your initial blush is you're probably not going to want to.
Well, especially not all at once. So I think a lot of times, usually when I get this question, people think of it as, do I convert my entire balance? Or at least a lot of times that's what I get. If anything, what you want to look at is if there are going to be years early in retirement, and this is a fairly common scenario where your income is going to be a lot lower than it is not just now, but lower than it will be in the future. And that happens typically when people have money outside of retirement accounts, like a taxable brokerage account that you can withdraw from, and you haven't claimed Social Security yet. So your income can be super low at first. In those years, you can convert at really low marginal tax brackets. And
when you say income, you mean your taxable income. You may have a handsome income, but it's not all that taxable.
Yeah, exactly. So your taxable income's low. If it's lower than what it will be in the future when you would withdraw the money from your IRA, theoretically, if you didn't convert, then that would be a good time to do it. So just putting numbers on it, like if you were able to convert money at the 12% marginal tax bracket now, but if you didn't do that and you looked into the future, you might get tripped into the 22% because you have big required minimum distributions 20 years down the road, then that's a scenario where you might consider a conversion. And I should probably say here too, always consult a CPA on anything tax related before you do it. But so wrapping that up or summarizing, for most people, there's probably not a super compelling reason to convert, but there are certain instances, primarily when your taxable income is really low, when you should look at it and say, does it make sense to convert at least a portion of my traditional IRA.
And the other thing I want to add to that is if you're going to do that, you also want to have be able to pay the tax separately out of another fund and not take it out of that amount that you're rolling in or converting into the Roth. But this is something that we monitor and we look out over the years. And what we're always trying to do is say, is there any reason to take advantage of either a Roth conversion? And if not a Roth conversion, how about if they have a taxable account with built-in long-term capital gains? Maybe we should harvest long-term capital gains at a 0% rate. So I think in summary, Dave, you'd say chances are you're going to find that they're not going to be that attractive, but you may have that situation. And mainly the situation is people that have low taxable income on the front end of retirement. That typically comes from people that have not taken Social Security yet, and they have this fund that's a taxable, non-tax privileged account that they can kind of live out of, keeping that taxable income down. Many times there's some favorable things to do from a conversion standpoint.
Right. It's just not easy for people to do that analysis on their own because you have to project your portfolio balance and required minimum distributions in the future. And we don't really know what tax rates are going to be. So you kind of have to base it on tax brackets now and make educated guesses. And that's why I always think when it comes to like a Roth conversion analysis, it's a really good idea to get a professional's help, even if that's probably a CPA, and say, here's what I'm thinking about doing. Let's make sure that there aren't any unintended consequences. Because like if people have claimed Social Security, if their taxable income's particularly low, it might not be taxable now, but if you convert it, it might make your Social Security taxable. So now, even though you thought you were in a low tax bracket, you're paying extra. It's like your marginal tax rate on additional income becomes higher because you're causing that Social Security to become taxable. So you just have to be careful with this stuff is really what I'm saying.
I think if people ought to inquire about it,
Yeah.
and at least put it on the box that needs to be checked. Should I or should I not look at Roth conversion potential, and then have somebody guide you through that? But it has to be someone who can simulate many years into the future, which is not predicting what it's going to be, but you're going to do thousands of simulations that give you a range of the benefit by whether you convert or not. It's not going to be a yes or no. It's probably going to end up being, well, 75% of the time you're going to be better off, and 25% of the time you wish you wouldn't, or something like that.
Thank you very much.
All right. I hope that helps.
Yes.
All right. Well, that was a good call. I think it seems like we're in the retirement planning business. So of course we naturally think in those terms on the front end of a relationship. That's one of the things we're always testing for, because ultimately it's the return you're after is the highest after tax, after inflation return. Taxation in retirement is a really important function, probably overplayed a little bit by the industry, but there's a lot of things sometimes there are a number of things you can do to really not only minimize taxes, but increase your wealth at the same time. And they're not always one and the same. You can do a lot of things that reduce your future taxes, but they also reduce your future wealth. Speaking of retirement, so there was a Secure Act that was sailed through the House. That was back in May. Months later, progress is the side of us. On that side of Congress is still elusive. The main goal, expand access to retirement savings. So this is something I want to talk about, but here's the main thing, guys. Allow small employers to band together to offer 401k plans. 401k plans are kind of expensive when you're a small company. So it is thought as way, if we could band together a bunch of them, get that purchasing power. Give part-time workers access to retirement plans. Take away the 70 and a half age limit for individual retirement account contributions, because now if you're 70 and a half, you can no longer put money in individual retirement account, and raise the required minimum distribution age to 72 from 70 and a half. But this is one that I think people won't like if it is part of it. And I think it will be. Put a 10-year time limit on how long a non-spouse beneficiaries can stretch out the inherited IRA. Right now, if you inherit an IRA and you're a non-spouse, say you're a child, you get to do it essentially over your life expectancy, which is a much lower, withdrawal required from an IRA, inherited IRA, than a 10-year period. So that could have some significant impacts. Then, of course, they're going to look at Social Security Act, 2100 Act, Fred. I could see it coming. I can see what's coming. It's supposed to run out the Social Security Trust Fund by 2035, and it doesn't mean there's no money. It just means that benefits would probably be cut by 80%. I mean, by 20%, so you get 80% of promised benefits. I guess basically, it also would give those who are going to get a benefit. A minimum benefit would be 25% more than the poverty line, so 25% above the poverty line. But here's what's really coming, and this is what people ought to think about. Calls for raising payroll taxes on wages over 400,000. Right now, the upper limit, once you get above 132,900, you're no longer taxed on your wages from Social Security. I look for that to be somewhat part of this in some format. What do you think, Fred?
First of all, I think that even though the law says that they have to cut benefits to match the shortfall, that's never going to happen. So I think that the 80% probably will never occur.
I agree.
They'll go back and change it somehow. So that's one thing. But beyond that, Social Security is just a very, very complex kind of thing. I think that there probably will be changes, but what you're talking about would be a huge tax increase for people who are earning 15% percentage point tax increase if you combine the employer and the employee for people who are having wage income. And you put that on top of a 5, 7, 8% state rate, and then the marginal rate is at the federal level of 40%. You got
pretty hefty,
above 50%. So they'll probably back into it some way and not go full force. Right,
phase it in. They're even talking about increasing the Social Security tax from 6.2% to I think 7.4. 7.4. That's a gradual phase in from 2020. This is what they're talking about. It's not been decided, but this is.
But Social Security has kind of run out of its easy options. When it started, it was really easy to increase benefits because most people hadn't worked very long under Social Security. They're getting a huge return for their contributions. That's gone now. Everyone who's retired now or retiring now has paid during their whole life. Raising rates was easy. It started at a really low rate. Now we're up to a combined rate of about 15%. So that's not easy to raise anymore.
Is the toughest part political?
Yeah, and political. And the other problem is that instead of having several workers for retiree, that's going to be reduced substantially. So all the things are working against Social Security in terms of the easy solution. So again, raising the rate might be a possibility, but I don't think that's going to happen anytime soon.
Okay.
But then we have this other, instead of looking for solutions, most of the candidates now are talking about increasing benefits. So the lack of funding has not stopped them from talking about expanding benefits.
Fractured fairy tales. That's you have politicians on both sides. They just promise everybody everything and we'll worry about the bill when we're dead and gone. Guys, I want to shift to long-term care. I had some other things on here, but I think this is an important one. And what kind of triggered the conversation today was the past just month, we've probably had 4 or 5 clients that have gotten an additional increase after 1 or 2 prior increases for their long-term care they bought years ago. And we're having to do an awful lot of analysis on, does it make sense to take the reduction in? For example, one of the options is typically you can take a reduction of the inflation benefit. You can cut your benefit, and it really takes quite a bit of analysis to do that. But I want to cover this because I also read something, and it wasn't part of our notes today, but I just read a study, and I don't have it in front of me, that said, actually, I used to say that running out of money before people run out of life in retirement was always the number one worry. Turns out healthcare now is, and healthcare is kind of, we also have to bring in long-term care. And it really is, am I going to lose my financial independence and dignity due to a healthcare problem or a long-term care problem? But so we're going to cover long-term care, Dave. So it's a big problem for retirees when we're preparing. It's the front end. It's on the front end of every meeting we have with clients. Okay, do you have long-term care insurance? If the answer is no, okay, then we're going to earmark, as part of this plan, we're going to earmark that as a goal to make sure that we have some type of coverage, even though we're self-insuring it, so to speak. So let's talk about the options. Can you just kind of lay out the options as you see it for people heading into retirement that are thinking about long-term care issues?
Yeah, it's really fairly simple. So I always just distill it down to 3 primary options. The first one that everyone thinks about is insurance. So you can buy long-term care insurance, and that will fund your expenses in a long-term care facility up to the benefits that you pay for, basically. And that's your first option. But the option that I think people don't think about is, it's not just buy insurance or don't buy insurance. It's, okay, well, you can buy insurance, or you can self-fund those expenses by, essentially, the way I'd think of it is, well, you could have just taken the premiums that you're paying in insurance premiums and invested them, or just take a lump sum of money and set it aside for that purpose. And then you're going to have this big bucket of money by the time you have long-term care expenses to help fund it. And then the third option is to ignore both of those and then rely on Medicaid. And there are some downsides to doing that, but that's one of those options where some people don't have a choice.
So is that where it comes down to many times when you're thinking through this, is where you fall on the income spectrum and like your net worth and where you fall in that spectrum?
Yeah, that's definitely a big influencer. So that's the way I organized. I wrote a blog post about this, and that's the way I organized it. Was right off the bat, let's get the two obvious ones kind of out of the way. The first obvious one is, if you have a low income or a low net worth, you probably can't afford long-term care insurance that provides a material amount of benefits. And when I say low, the example I use is, okay, if you're living on $30,000 or $40,000 a year, to buy a long-term care insurance policy for both spouses that actually covers like 3 to 5 years in a nursing home at like full cost is going to cost you several $1,000s. So now you just, probably like 4 or 5 a piece.
Yeah, that's what I mean.
So you're looking at several $1,000s combined, $7,000, $8,000, $9,000
Right.
combined, depending on it depends on the exact benefits of the policy. Well, you just significantly cut into your lifestyle. I mean, that's the type of, you can call it a pay cut or income decrease that most people just can't make. It's just not even an option. And then if you have $100,000 or a couple $100,000 in assets, trying to set that money aside or use it to buy insurance, it's really just not enough unless you just don't need that money at all. So for people who are retired, if they had a couple $100,000 to really fund material long-term care expenses, it's like, okay, well, you can't really touch that money until it's
Right.
like you have to set that full amount. And most people just can't afford to do that. So these are the type of people where it's your default option is relying on Medicaid. And there are some downsides to that, like you're limited in terms of which facilities you can go into, and some of the facilities have a limited number of beds for Medicaid recipients because they don't get basically as much money from Medicaid as they do from the people who are paying out of pocket or from insurance. So I like to think of that primarily as a last resort, but it is an unfortunate reality that most people end up relying on Medicaid for their long-term care.
And what about the other end of the spectrum? Okay, now the high net worth person, and then we'll get to the kind of the people in the middle that's where it gets difficult.
Right. So if you look at someone who has a couple $100,000 of income in retirement, or they have a portfolio of $4 or $5 million, now you're looking at the type of income and net worth where you can basically fund even the most expensive types of long-term care almost in perpetuity. Because if you look even at home health care around here, it's a couple $100,000 a year, isn't that
for 24/7 care?
Right.
Probably somewhere in that.
And it can be less if it's not 24/7, but you start looking at a $4 or $5 million portfolio, you can fund that all for a lot of years,
Sure.
Unless returns are really, really horrible. So these are the type of people where you can easily afford to self-fund. And then the only caveat to that is if it just makes you feel better to have insurance, you're also at the level of wealth where you can kind of just do what feels best, because you can easily pay for really good insurance too. You just don't need to do it.
And what about the people squeezed in the middle?
So these are the people where I like to say you should seriously consider the pros and cons of insurance versus self-funding long-term care expenses. And this is something that I don't think people talk about nearly enough. I do think people phrase it as you either buy insurance or you just ignore the problem. It's like those are not the two alternatives. You can buy insurance, or you can try to self-fund it by setting money aside specifically for that purpose. And so what I did is I listed some of the pros and cons of each option. So the first consideration, I think, is costs. Obviously, you want to know, well, how much is each option going to cost me? And what I've found doing plans, and I'm not going to even provide the specific numbers, you can see that in my article, but the costs are pretty comparable. So how much, basically the premiums that you would have to pay for a good long-term care policy is about how much money you would have to set aside each year to fund an equivalent amount of long-term care expenses on your own, if you just set that money aside and invested it in a reasonable investment.
And that's somebody on the front end of retirement who might be somewhere around 60-ish.
Right. It kind of,
that may live,
but it kind of stays
their
steady
90s.
Because if the earlier you start, the lower your premiums are going to be, but the less money you'd have to invest.
Right.
The later you started, your premiums are going to be really high, or you're going to have to set aside a lot
Just
of money.
as if you were buying premiums, the later you wait to earmark money, the more money you have to earmark.
Right. So usually, like I said, the costs are pretty comparable. Now, I think a big consideration for people is that the costs of long-term care insurance are not guaranteed. And I think that's what you were talking about when you introduced this is we frequently get clients coming into our office saying, I got a notice again from my long-term care insurance company that my premiums are going to increase substantially,
Sometimes
or I have
double.
to cut my benefit or cut my inflation rider or some combination of these.
Right.
And that really bothers people because we're talking about thousands of dollars a lot of times per year in premium increases. And it's something that you just, it's not me saying you shouldn't buy insurance for this reason. It's just something when you buy it, you need to know that that's a possibility and be okay with that possibility and be able to fund higher premiums potentially.
Is there a thought that the companies today are better at pricing these things, and so maybe people buying a policy today may not have as many shocks or any shocks in the future?
Well, yeah, I mean, everything I read basically says that. So the reason that they've had to increase premium so much is they overestimated how many people would lapse on their policies. So people who pay in for a little while and then just drop the policy, and then it's kind of like the insurance company got free money. They overestimated the people who would lapse. So more people are just sticking with their policies. And then they also didn't necessarily account for the fact that interest rates are going to be at extreme lows as they have been for the last several years.
Okay.
You would think now their actuaries would account for those things. They've adjusted their assumptions. So hopefully this is less of an issue going forward.
Are there still many providers? Some people withdrawn from the.
It's fewer and fewer. Like we just had a client that I was talking to. He's actually in a long-term care facility now, and I was talking to his daughter. And the policy that they have is through a company that they don't issue new policies, for example. And yeah, the number of companies that are issuing long-term care insurance has shrunk significantly.
There's a handful at best.
Yep. So then the second consideration I talk about is guaranteed versus non-guaranteed coverage amount. So when you think of insurance, you're paying your premiums, and then in exchange for that, you're getting a certain amount of insurance benefits. Basically, it's going to be a certain amount per month up to a lifetime maximum. So it might be, okay, you get 3 years, up to 3 years at $90,000 a year or whatever it is. Usually they do a daily benefit amount, but it kind of works out that way. So let's just say, okay, we know for a fact I've got a lifetime max of $300,000 of benefits. I'm just pulling a number out of my head. If you take the self-funding route, I mentioned the cost of self-funding that I calculated is somewhat comparable. Well, that's based on a really high likelihood of success, basically using what our Monte Carlo simulation software. But that's not like a guarantee because it's the amount of money that you end up with set aside for insurance or for long-term care expenses when you need it is going to depend a lot on the investment returns that you earn.
Of course.
And when we're dealing even with 15, 20-year periods for a typical retiree, maybe a little longer, there's a lot of uncertainty around investment returns. And the amount of money that you have available to fund long-term care expenses could be very different if you get a good draw versus a bad draw in terms of investment returns. And that uncertainty really bothers some people. So I think this gets down to a psychological preference. Some people prefer guarantees. That gives them comfort. Some people prefer the fact that, well, there's more upside potential with self-funding, and I'm willing to put up with the basically fluctuation and uncertainty involved in self-funding in exchange for that potential upside.
Okay, then what about this use it or lose it? We hear a lot of people kind of wrestle with that. Well, but Fred just talked about it. We're kind of glad when our house doesn't burn down, and we gladly pay those premiums. It's a little different, more different when it comes to the psychology around long-term care, isn't it?
Yeah, I think that's one of the things people really don't like about traditional long-term care insurance. And I think it's because it's so expensive. So you think about, okay, I'm paying several $1,000s a year in long-term care insurance premiums. And then if I don't need it, or if I die during the elimination period, which I can kind of talk about, and I don't get any benefits in return, well, that just really bothers people because that's hundreds of thousands of dollars that could have gone to their children or wherever they wanted their money to go. It's essentially wasted money. And as Dr. Gertz mentioned, It's like, I don't really see that as necessarily a problem because that's how a lot of types of insurance work. It's like, really, that's kind of the best case scenario because you didn't have your health decline and need to go into a
You buy
long-term
life
care.
insurance so you don't die. That's
Yeah, exactly. Yeah. Most types of, or like your example, homeowners insurance, you want those premiums to be wasted. You don't want your house to burn down. But that does really bother people. And that's one of the major advantages that I see of self-funding is if you set this money aside for long-term care expenses, but then you don't end up having long-term care expenses, well, then that money can go to your children or wherever, or your heirs, just wherever your will or your trust says your money's going to go. So I think that's a major consideration for people. And again, that's more of a psychological consideration.
Well, you
Which do
mentioned
you prefer?
You mentioned the coverage doesn't kick in right away either, and that's kind of an issue, a side issue as well, isn't it?
Right. So that's another consideration with insurance is just some of the, I guess you can call it like limitations to it. The first one, and I think the biggest consideration is almost all insurance has, long-term care insurance has what's called an elimination period. And that's a period of time where you have to cover your own costs before the policy starts paying benefits. And they can range in duration, but the most common one's 90 days. So it does happen. And we had a client actually where he went into a long-term care facility and he died before the elimination period was up. So his long-term care insurance was basically wasted, even though he did have some long-term care expenses. So that's something that, people need to be aware of. And then there also are issues sometimes with daily benefit caps or monthly benefit caps, particularly daily, where if you have a lot of, expensive treatment on a single day and you're capped at, $250 a day, but your expenses were $500, you might not be fully reimbursed. So there are some just, I guess, quirks of dealing with insurance and getting your benefits that you don't have to deal with if you self-fund.
You've always said you should be able to pick a 1 or a 2 year elimination period. And then, and I think maybe that will be one of the hybrid solutions. What about protecting assets from Medicare spend down requirements? Ryan, you've written quite a bit about this. We have about 4 or 5 minutes here. Maybe you can just kind of give us your thoughts, put it all together a little bit.
Sure. So for somebody who is considering or has no other option but to go on to Medicaid, there is a requirement to spend down your money, and it's quite considerable. So you, as a single person going into potentially a Medicaid facility, you have to spend down your assets to $2,000. So it's very, very low. If you're a dual applicant, you're married, and both spouses are going in together, it's $3,000. So you get a slight uptick. But the one thing that I think is good to know is for folks who are a married couple in this instance, and only one's going into a facility for a nursing home through Medicaid. Again, the spouse who is the non-applicant, who is otherwise called the community spouse, they can keep about $110,000 of assets, even though the one spouse who's going in would normally only be able to keep $2,000. So it's good to know that that's the Illinois state amount. It's different by state. But it's good to know that if you only have one spouse going in, you don't have to all of a sudden live in the poverty line of $2,000.
Okay, but you're still you can see it from there.
You can see it. It's not too far out. And
Would it be fair to say, guys, both of you, this part of this analysis takes the psychological and emotional component into, if you're doing it properly, you have to take that into account with the client?
I think so. And I think a lot of these issues do have a psychological component to it. So preference, like how much does use it or lose it bother you? How much does fluctuation of your portfolio balance bother you and not having this guaranteed insurance? And some people just feel better just knowing that they have insurance. A lot of these things, you do have to consider your psychological preference. And then one other consideration I was going to mention, because I was talking to a client recently, was actually the child of the client whose parent is in the nursing home now. And they had a nightmare experience getting their policy to actually, or their insurance company to actually pay benefits. So one of the potential downsides, depending on the scenario and the company, is just dealing with the insurance company, getting them to pay the benefits. So this particular client was in and out of a facility, getting kind of like rehab care. And for some reason that really messed with like qualifying for the elimination period and whatever. And she just said it was an absolute nightmare trying to get them to pay benefits. They finally did, but her comment was it was the reason that she and her husband chose not to purchase long-term care insurance and they chose to self-fund. Now, she said they do have friends who had no issues with it. So it's going to depend, but it's just something I think people don't always consider.
So you might want to have a strong advocate if you're considering the long-term care option to potentially go to bat for you with the insurance company.
So you
Exactly.
want you want a very strong agent in that one. Well, to me, to sum up the long-term care thing, the most important thing is to build a plan for how you'll handle those potential long-term care issues. I think you do that well in advance. And I think that's when you're talking about your advisor saying, hey, there's this one thing keeping me up between 1 and 3 in the morning. We've seen friends that had these, experiences, and we somehow want to know that we have some or complete protection against that. And that can help you live the final years. This is my experience. After 35 years, I get to see people who retire peacefully through all phases, at least financially. We all have families, so it can't be completely peaceful. But the final years of your life, you just really never want to worry about your financial independence and dignity. You don't want to be, even in America, you don't want to be poor and old. It's not a good combination, and it takes planning, and planning takes a planner. And so it doesn't have to be us, but I think if I could wave a magic wand, everybody would be mandated to see some sort of financial planner and retirement planner. It just should be part of our system in place. So I won't pontificate on that any longer, but a lot of these issues can be dealt with proper planning. Well, Fred, sorry, you got a lot of the front end, but Dave hogged the rest of the show.
Things, yeah.
Dr. Fred and Ryan, thanks for showing up as well and participating in the show. Well, we'll be back in 2 weeks with Paul Ruedi's On the Money. Glad again to be voted #1 investment firm in Central Illinois People's Choice Awards. We'll see you in 2 weeks.
Join us for the